Today, we're looking at an investment thesis, the sleeping giant, why AMC could explode in 2026.
Right, the one that argues survival, supply, and sentiment are all converging just in time for that massive 2026 film slate.
Exactly. So let's jump right into the first big piece of this, which is the operational argument.
Okay.
The writer makes a really compelling case for operational efficiency. They're citing record numbers, like Q3 2025 admissions revenue per patron hitting $12.25.
And record concession sales, yep.
So the efficiency is there.
Oh, the efficiency is undeniable, but it's efficiency on a pretty thin crowd, isn't it? The core operational strength has to be framed more explicitly against those lingering attendance challenges.
To really establish the survival narrative.
Exactly. The material sort of relies entirely on that future volume. You know, Avengers, Doomsday, and Spider-Man 4 to bail out the current attendance numbers.
Right. So the weakness is that it's all banking on the future.
Yes, we need proof of survival today. The suggestion is to connect those operational efficiencies directly to the company's current financial stability.
Show that the business model is de-risked even before that 2026 supercycle hits.
That's it. Show us the model works now.
Okay, so how do we make that actionable? What's a concrete example?
You could introduce a metric that clarifies the shift in their operational break-even point.
Ah, okay.
For instance, you could explicitly show how these efficiency measures mean they need, say, significantly lower attendance now to be profitable compared to 2019 levels.
Or connect the improvements to a specific margin gain, something that just validates the current operational strength on its own.
Precisely. That solidifies the foundation of the whole thesis.
Okay, that makes sense. Let's pivot to the second point, the valuation. The piece rightly points out that the bearish debt war narrative has collapsed. They've refinanced out to 2029 and 2030 and got that S&P upgrade to CCC+.
And removing that debt risk is huge. But the link between that successful refinancing and a sustained valuation multiple expansion, it needs a stronger quantitative foundation.
Stronger than just the short squeeze potential?
Yes, exactly. The assertion of this major multiple expansion seems way too reliant on the short interest, that 10% squeeze dynamic.
Which is temporary, it's just sentiment. So the weakness is that the argument needs to really articulate why the market should fundamentally re-rate the stock.
Especially with a CCC Plus rating still attached to it.
Right.
So the suggestion is to focus on how removing that debt overhang structurally improves the certainty of generating positive free cash flow.
Ah, okay. That's the key?
Because by solidifying future FCF, you allow the market to value those huge 2026 revenues at a much lower discount rate. That's your fundamental re-rating catalyst, not a squeeze.
That's a great distinction. It ties the debt relief directly to reduced risk in the actual business model.
It does.
So give me a concrete example of how to build that case.
You could tie that S&P CCC Plus upgrade to a specific next target rating, like, say, a B.
Okay.
And then you detail what level of recurring positive FCF, or maybe reduced interest expense, is required to achieve that next target. That provides a clear structural path for valuation expansion.
A path that is completely separate from the temporary short interest dynamic.
That's the one.
Fantastic. Okay, so to sum up the actionable suggestions here for the author.
Yep.
First, integrate those operational efficiency figures with the attendance metrics to really solidify the current de-risked baseline survival narrative. Prove the model is robust right now.
And second, strengthen that argument for multiple expansion. Shift the focus from the short squeeze to how debt management structurally reduces risk and ensures stable free cash flow. Give the market a clear, fundamental reason to re-rate the stock.
Great points. Get to work on those, and we invite you to submit the revised analysis back in for our next discussion.